Welcome to Insured Investors, where we share practical real estate investing tips with an insurance twist. I'm your host, Brooke Beets. Let's get started. When most people hear about real estate investing, they think about short-term, long-term, vacation rentals, even renovation and flipping. But there are many strategies, and insuring them aren't always that straightforward or easy. That's why we have Jacqui Price here today. Jacqui is EVP of Compliance at National Real Estate Insurance Group. She started her insurance career in 2012 when she worked for a local State Farm agent. After 4 years, Jacqui decided to join the INREG team, and during her time, her vast insurance knowledge has contributed to her success here at the company. She was once a landlord for 3 years, and based on that tenant experience, she has decided to stick to insurance. So welcome, Jacqui. Nice to have you here.
Thank you, Brooke. I'm happy to be here.
So, creative insurance strategies, we know, is a very large topic, and we have many clients who have a lot of different portfolios and ways to insure their locations.
Mm-hmm.
So lots of things to talk about today. Let's start with subject to.
Okay. So a subject to is essentially when an investor purchases a property subject to the existing mortgage. So that's how it gets its name. So let's say that you own a property and you're looking to sell it, and I am an investor who's looking to purchase that property from you. But for one reason or another, I do not want to get a loan on my own, and so I buy the property subject to your existing mortgage. And that means I start making the mortgage payments directly to your lender on your behalf. But within that transaction, the deed gets transferred over to my name, and I become the owner of the property.
Okay. So I can think of a lot of scenarios of why someone would want to have someone else take over the payments of the property. So thinking of insurance terms, what does that look like? How would we advise the documents to look?
That's a great question, and it's something that I don't think a lot of investors maybe think about, because first and foremost, the most important rule that I would give to an investor who is investing in subject to properties is do not assume that the seller's homeowner's insurance is going to cover you if there's a loss to the house. The seller's homeowner's insurance is for an owner-occupied property that they own and also live in. So even if the seller is still going to be residing in the house, they no longer own the property. So they should not keep an homeowner's policy in place. It would not protect them properly. Instead, you should purchase a investment property policy like we sell at INREG, and you would want to make sure that you are the named insured. And that protects you if at claim time that you would be named on the claim check, and the seller would not be named on the claim check. And so that's really important, because when the loss happens, you don't want to have to get the seller to sign off on the check that is rightfully yours. Another thing that I think that you should consider is keeping the seller as an additional interest on the liability coverage. Because while they no longer need to be on the property insurance, you still want them, they still have a liability risk on the property because they're still named on the loan. And so they likely would like to be named on the liability insurance, and that is fine too. The last piece of information that I will give you about how to properly insure a subject to property is to make sure that the lender is named on the documents. It sounds silly, it sounds like something that everyone knows how to do, but that's very important to make sure that the loan doesn't get called due. So those are three things. You want to make sure it's an investment property policy in your name. You want to make sure that the seller is not named on the property coverage, and that the lender is properly named so that they are satisfied with your coverage documents.
Okay, very good information. Another strategy that we've seen our clients bring to us is non-performing notes. So talk us through that one.
Non-performing notes, I'm not going to lie, is something that it took a long time for me to wrap my head around. So I want to go through a real-life example with you. So you own a property, and for whatever reason, you're no longer able to make the mortgage payments. Your lender, let's say after 3 months of you not being able to make the loan payments, has a decision to make. Some lenders decide that they don't want to go through the foreclosure process, and instead they sell the note to an investor. As an investor, I can go to that lender and purchase the note from them, and I essentially would become your lender. Okay? Does that make sense so far?
It does. So I couldn't pay,
Mm-hmm.
so you take over.
Right. So something that as an investor I could do after I take over the note is I come to you and I try to rework your payments. Maybe I know that you're on hard times right now, but we work on a graduated payment plan so that you could pay off your loan over time.
Mm-hmm.
Or potentially I could extend the period of the loan so that you could make smaller payments and still pay it off. So in my example, let's say that your loan outstanding, it was for $100,000 with your lender. Mm-hmm. When I purchased the note, I purchased it from your lender for $50,000. I purchased it at 50% of what the loan value was. If I can rework the terms of the loan with you and get you to pay me back in full, I've essentially made $50,000 plus the interest that is part of our agreement in my investment, and then I can sell the deed back to you once the loan is paid in full.
So that's a high risk, high reward strategy.
Yes, definitely high risk, but I'm sure investors find that works out for them.
Mm-hmm.
The other option would be if you are unable to make the payments or we're unable to come to terms on a new payment strategy, I could foreclose on the house. That puts a lot more risk on me as the investor, but once that goes through and I'm through the foreclosure process, I now have an investment property that I can sell or renovate or, rent out to another tenant. And so I have, for $50,000, now acquired an investment property. So.
Okay, so definitely a good strategy for some of our clients.
Right.
So bringing it back to insurance, what does that look like? How should I insure that?
Well, you want to make sure that you have insurance as soon as you purchase the note, of course, and you want to make sure that the insurance covers at least the amount of the note. So even though I bought it for $50,000, the full note is worth $100,000. I want to make sure that I insure that property for at least $100,000, and just in case something does happen to that property, I could potentially insure it for the replacement cost, but I want to make sure I at least insure it for the value of the note. And once the homeowner, if I'm able to come to terms with you and as the homeowner and you're able to start making payments to me and you can show me that you have valid homeowners coverage, I could potentially drop my investor coverage because we now have an agreement. We now have a loan agreement that you're paying and you have an active certificate of insurance that you can show me. And so that just like that, then I'm a lender. I'm just named on your policy. That's very important. But until we get to that point, until you have shown me that you have current insurance in place, I need to make sure I have insurance to purchase to protect myself.
You would be the named insured in that case.
I would, definitely. The insurance always follows the person who holds the deed or who holds, in this case, the note. So we want to make sure that I have insurance at least until you can prove to me that you have your own insurance policy that is current and up to my requirements.
Okay.
Yeah.
So moving on, let's talk about a tax sale.
Oh, there's two different kinds of tax sales actually. There's a tax lien and there's a tax deed sale. And so essentially when a homeowner is no longer able or for some reason has not paid their taxes to their county, the county can auction their deed on essentially the courthouse steps. A tax lien will only auction off their taxes that are due. And so, let's say, again, you're going to be, the homeowner that, or the seller, the homeowner that no longer has enough money to pay for their taxes. But let's say you owe $12,000 to the county. I, as the investor, will go to the courthouse. I will go on auction day, and I will purchase your tax lien for $12,000. I can now work with you to pay back your tax lien to me with interest, of course, over a course of a period of time. So let's say 60 days. So you and I work together. You pay off your $12,000 plus interest to me, and at day 60, as long as it's paid off, you now own your deed in full, in right, and I no longer have an interest in your property.
Okay. So as an investor, if I were going to buy, you're coming to buy mine on the courthouse, you're paying cash for that.
Yes.
It's just a quick transaction.
Right.
So at that time, do you need insurance or?
Of course,
Okay.
yes. So that is a common misconception with tax liens, because as the investor purchasing it, I know that at day 60 or any time that you pay off your tax lien to me, the deed could go back to you. So I may say, well, I'm not going to get insurance until I know that it's my property. But what happens if on day 60 it becomes my property, but on day 59 the house burnt down, and now I've been given a deed of a house that needs to be demolished? That's not what I want. So I always recommend that as soon as you have an interest in the property from a tax lien, that you insure it. On the other side is a tax deed, and that is where the county sells the entire deed on the courthouse steps, and it's a one and done transaction. So I could still purchase your property for $12,000, but there's no period of time where you could pay me back and keep your property. The deed becomes mine immediately. And so then I own the property outright from there. And that is where at INREG we've had clients call us from the courthouse steps and say, I just bought a property, I need to insure it. Now sometimes they don't know much about the property. They've likely never seen it. They don't know the condition. So your coverage may be more limited than a property where you can fully answer all of our underwriting questions. But at least getting liability coverage on the property should there be an accident, and getting even limited property coverage on the property at the time that you take over ownership is vital to making sure that if something happened to that property, you would be covered.
Okay. And that's just great. That's just great advice in general.
Oh, of
Anytime
course.
you're taking over a property, no matter the situation or the strategy, get insurance right away.
Oh, of course. I mean, it's not like when you purchase a car that you have 14 days or 30 days with your insurance company to add your new car on. Property insurance doesn't work like that. If you purchase the home at 1 o'clock in the afternoon and there's a loss at 3 o'clock and you didn't call your insurance carrier or your insurance agent before then, you likely may not have coverage.
How about a land contract and contract for deed? How common are these, by the way?
We do have clients that invest in land contracts or in contracts for deeds. I don't think that they're super popular, but we do have clients that do this on a regular basis. So we call them two different things: land contract or contract for deed. They are two different types of transactions, but from an insurance perspective, they're pretty similar. I like to think of it as a rent-to-own type of situation, where the seller, so now you're going to sell me a house again, but you're going to sell it and you're going to be my my lender. Perhaps I can't get a loan, and so you have a property that you're like, I will sell it to you for whatever our agreed amount is, but I'm going to make monthly payments to you directly. So essentially, I would be renting the property from you, but after 3 years and I've paid off the full debt, you transfer the deed to me. Okay? So in this case, I always recommend that the insurance follows whoever holds the deed. So that doesn't necessarily mean that the person who pays for the insurance has to follow the deed, but the person who's named on the coverage, who is going to be named on the claim check, should be named on the insurance, or should be the person on the deed. So you're going to be selling the property to me. I'm going to be paying you monthly installments over 3 years. And it's not until month 36 that I become the owner of the property. So you want to make sure that you're holding the insurance while you own the deed. And then on month 36, once I make my final payment, I need to immediately get insurance on that location. So that's a little bit different than the other strategies that we've been talking about.
Okay. Last one, sandwich lease.
Oh, sandwich lease. So this is a term that I love because it's a funny vision in my head. So a sandwich lease can also be called a triple net lease, but ultimately it means there's 3 parties, and it's called a sandwich lease because essentially there's 2 pieces of bread and then there's the meat in the middle, and that makes up the three parties that are part of this lease agreement. Okay?
Got it.
So, in this scenario, the property owner is going to lease the property to a middleman, so the meat of the sandwich, for an extended period of time, most likely. So let's say you're going to lease the property to me for 3 years. So now you own the property. You want to make sure that you insure the property for property and liability coverage and whatever you would have as a normal investor. That's very important. But you and I have agreed that I am going to then essentially sublease the property for various reasons. I know we have a client who subleases properties as vacation rentals. Okay? Mm-hmm. So you own the property. I am subleasing the property for 3 years. And during those 3 years, I'm going to lease it out every week for a vacation rental. But it doesn't have to be a vacation rental. That's just the client that I have the most experience with. I could rent it out as my own long-term rental on an annual basis. I could do a corporate rental. Sometimes it could be like a commercial space where I'm renting it out to a business. But you only want to lease it to me, and then I lease it to other parties. Okay. Go ahead. No.
So what does the insurance look like for this one?
Yes, that's a great question. So like I said, as the owner, you want to make sure you continue to have your own coverage for it. But you also need to make sure that the middleman, so the meat of the sandwich, you need to make sure that they have their own liability coverage. Because as the person who is now going to be subleasing the property, I have my own business activities and my own liability exposure. So you want to make sure that I have business liability coverage to protect both of us should something go wrong. Should there be a slip and fall, or should someone get hurt on the property from a deck collapse or a faulty stair or something like that. You want to make sure that I have insurance. And it's most important that I name you on my policy. Because if you are also called into the lawsuit because you own the property, you want to make sure that you have coverage on my policy as well.
So I have a policy, I'm the named insured.
Mm-hmm.
You have a separate policy.
Yes, completely separate.
For your business operations.
Right.
And I am named additional insured on your policy.
Yes, that is accurate. So I cannot get property coverage because I don't actually own the property, and that is something that I have found has been confusing to some investors at times. But I don't actually own the property. If I had contents in the property, so if I had staging furniture or even if I had vacation rental furniture in the property, I might want my policy to cover the contents, but I can't actually cover the structure because I don't own it. So mine would only be a liability policy for my operations, yes.
Okay. So a lot of different ways to invest and insure.
Yes, it is. It's a lot of information, but we just find that it's overwhelming when you are investing in a situation that's uncommon and you're not sure how to insure it. And so we want to make sure that we advise all of our clients how to best insure when they are doing these creative investing strategies.
We will continue to post new episodes every other week on INREG's YouTube channel. That's NREIG, and on Spotify at Insured Investors. You can also follow INREG on Facebook and LinkedIn. If you have topic ideas or questions, please leave them in the comments below. We'll see you soon!